what I'm going to have to do is, since we don't have a quorum, I don't think I can open the meeting. But what I'd like to do is have Freddie walk us through our agenda. He's got some recommendations for searches that we asked him to do already. He's got another one that just showed up, that maybe a candidate consolidation. I'm wondering if at some point during this that we could take an informal vote, and then maybe we could do a vote by email. You know, maybe it's a possibility, so we could firm up in here while we're talking what the recommendation is, and then Ron, you could send out an email and just say, here are the recommendations from our discussion on these documents, and see if they're willing to vote by email. That would be just.
We don't have to miss a quarter.
I don't want to rehash everything next quarter either, because it'll be all old news. So.
That's right.
So I don't know. That's the fact that this isn't a public meeting. I think I can probably get away with that, but being that there are no union representatives at the table today, I'm a little bit nervous about sticking my neck out too far. So maybe that makes sense. And if they balk at it and say, no, that's not right, we want to come and look at all the materials and all this.
I'll give them the choice of voting or deferring.
Yeah. Okay.
I'll remind them the documents are in Dropbox.
So just so we're on it at the moment, there's those of us that are here. I mean, I reviewed the meeting minutes from last quarter. I didn't have any changes or corrections, so where we're at. Does anybody have anything that needed to add? So as long as just reflect that we did vote on the minutes, but none of us had anything to change or add. Okay. Consent item, T. Rowe Price retirement balanced.
Below 50th percentile in their Morningstar category for 3 and 5 year. So it's not something that has to be voted on. It'll be a new watch list fund. Now,
Is that the one
yes,
that you mentioned has $15,000?
it's only 50,000, and we get
1.5?
into 1.5, and when we get into the fund balances, I'll show you a consolidation opportunity with that.
Okay.
Now, just to clarify, so I can have accurate representation of my own notes to help Ron with the minutes, the fact that there's no quorum, does that still register as a consent item by previous?
Yes, by definition.
Okay.
I think so.
We don't notice this meeting like that.
No, it's not a public meeting. That's. I mean, I feel like I could take a little bit of liberty, but the problem is I got to make sure my bargaining unit friends agree with that. It depends on how crazy Freddie gets with me today. These crazy ideas that take these lengthy explanations.
I'll keep
You had to
it
be
in
there to appreciate it, I have to say. You know?
Yeah.
The joke's never the same when someone else tells it later.
It's going to get diluted, and
That's right.
yes, yeah.
That's screwed up. The timing won't be right.
So, am I up?
Yep, you are.
Okay.
Quarterly investments.
Okay.
Capital markets.
And before I get into that, I just wanted to acknowledge one more time, and I don't know if Brittany's aware, but last time we met, it was announced that the City of Las Vegas was a national finalist for the National Award Retirement Plan Sponsor of the Year, and now a quarter later, having the benefit of knowing and the recognition at City Council meeting, it's an honor and privilege for me to be working with a committee that the city that won a national award. So it's very gratifying, and philosophically speaking, it's cool in that if you've ever competed in anything, whether it's sport or a civic competition or something in the business realm, there's a very small percentage of anybody that can ever hoist a championship trophy and declare themselves champion of anything. So you think of it that way, I think it's pretty darn cool. So congratulations, you guys have a lot to be proud of. So.
Thanks, Fred.
So.
Yeah, I have to say congratulations and thank you to
you.
Well, it's not my award. I mean, I like to think maybe it shines on Morgan Stanley, but it's your award, and you're the committee that made the decisions
That's
to.
your sage advice, then.
Well, it's been nice to be a part of it. So the capital markets overview. Market performance in the first quarter of 2005 has hung on every word of action and action or inaction by the Federal Reserve and its chair, Janet Yellen. From the fundamental standpoint, this year has been similar to the last year in that the U.S. economy suffered from a harsh winter. We're just talking about that, John. Leaving first quarter real GDP growth below the already anemic 2% trend line growth in place since the financial crisis. Market volatility was driven by the relentless decline in commodity prices and the rise in the U.S. dollar. The Dow Jones Industrial Average was up 0.3% for the quarter. The NASDAQ was up 3.9%. The S&P was up 1% for the quarter, its ninth consecutive quarterly increase. 6 out of the 10 sectors of the S&P 500 advanced for the first quarter. Healthcare fared the best with a 6.5% uptick. Consumer discretionary was up 4.8%, and telecom was up 1.5%. The laggards were utilities, which is not surprising given the rise or anticipated rise in interest rates. It's an interest rate sensitive sector. Utilities were down 5.2%. Energy was down 2.9%. Financials were down 2.1%. Morgan Stanley economists expect U.S. real GDP to be 2.4% in 2013. In 2014. And by the way, that data will be released in 2 days from now. 2.4% for last year, increasing to 3.3% this year, and the global GDP forecast was projected to be 3.3% in 2014 and 3.5% in 2015. Commodities struggled for the quarter. The Bloomberg Commodity Index was down 5.9% for the quarter. Gold was down 0.2%. For U.S. economy, the unemployment rate fell from 5.6% for December 2014 to 5.5% for December 2015. The employment rate, 5.5%, represents the unemployment rate of 5.5% represents 8.7 million unemployed Americans. Inflation remained low in the U.S. The consumer price index decreased 0.7% in January and increased 0.2% in February. Morgan Stanley economists forecast a 1.6% inflation rate for 2014 and a negative 0.3% rate for 2015. Private sector housing starts in February 2015 were seasonally adjusted at an annual rate of 897,000 homes, which is 3.3% below February housing starts. The rise in housing starts over the past several years indicates that despite some intermittent setbacks, housing market is rebounding. In March, the Institute for Supply Management's Purchasing Managers Index, PMI, that's an index for the manufacturing sector, was 51.5, down 1.4 from February and down from January's 53.5 reading. The latest PMI data indicates an expansion in manufacturing sector for 23 consecutive months. Generally speaking, a reading over 50 indicates that the sector is expanding. We talked about the index returns for the capital markets. From a style perspective, growth style stocks of large companies rose for the first quarter. The Russell 1000 Growth Index advanced 3.8% compared to just the Russell 1000 Blended Index was up 1.6%. The Russell 1000 Value Index, also a large cap index, decreased 0.7% for the quarter. Mid caps increased 4% and small caps rose 4.3%. For the global markets, emerging markets and global equities had positive results. The EFA index, which is a benchmark for developed markets, rose 5% for U.S. currency investors and rose 11% for local currency investors. In other words, if you invested in foreign stocks and you live in those foreign countries, you realize 11% return. But as an American investor, because the dollar strengthened to do that exchange rate back, it netted out to a 5% return for U.S. investors. Emerging markets were up 2.3% for U.S. currency investors and 4.9% for local currency investors. And Europe was up 3.6% and 11% for the local currency. The BRIC countries, Brazil, Russia, India, and China, was up 3.6%. For the bond market, had some slight increases for the quarter. The Barclays U.S. Aggregate Index, the general measure of the bond market, rose 1.6% for the quarter. Interest rates declined for the first quarter as the yield on the 10-year Treasury note fell to a quarter-end 1.92% from 2.17% at the end of the fourth quarter. Today, the 10-year Treasury has gone up significantly since then. It's up to a 2.13 today. So if you ever want to refinance a mortgage, it's going to be keyed off the 10-year Treasury. Riskier parts of the bond market, high yield specifically, was positive, up 2.5% for the quarter.
Question. Did you have that in our packet? Because it wasn't in our Dropbox.
No, it's not.
That's just something.
It's
bring
not.
in.
I can
No, it's
send
good.
it. Okay.
I mean, it'd be great if it was in the packet, in the Dropbox packet.
Okay.
You may not have it ready by then. No big deal.
Okay. And also, before I forget, there were some items in the minutes that indicate some follow-up with, Mass Mutual and the general account. So I'm going to include that in this Mass Mutual review. And Ron, we're going to look at the Mass Mutual review here. Okay.
Ron's driving.
Mutual Q1 315.
Yep. So if you go to page 7, the executive summary. See that there's one watch list fund, which is much less than at some point in the past. American Funds Capital World Growth and Income Fund. If you go to page 8, here's what I call the 30,000-foot view of the funds within Mass Mutual. And under the T. Rowe Price target date portfolio, you got the 2015, 25, 35, 45, and 55. And today, there are 28 funds within Mass Mutual.
This is way off the record, but the funny thing, I had a performance metric with my boss that we were going to have. I forgot about it until I just, it's appraisal time, right? I had a objective of reducing the aggregate fund numbers by 30%.
That was your.
It was real aggressive.
Your own objective?
Yeah.
Set when?
Would have been a year ago.
Okay.
But
well, we're halfway there.
We're halfway there, yeah. And I know
So
we've been
better-
talking about trying to get the other half, but
Yeah.
I thought I'd share that with you.
No, I
It's
still.
funny,
It's,
you guys think you have problems with your performance appraisal.
Yeah, right.
well, it's an interesting statement to make because I think it's a good goal.
I think it's a realistic goal.
It's
just
a
gonna
realistic
take longer
goal.
to get there.
The true fix would be consolidation.
Well, there he goes again.
Okay. All right. So
The audience you want to talk to isn't here right now.
right. So if you go to page 11, here's the fund lineup and the balances. And if you look under the balanced asset allocation, this T. Rowe Price retirement balanced was just put on the watch list by consent. There's only less than 16,000. And when we get into deeper, I could show you something that you could take an informal vote on to consolidate into Oakmark Equity and Income. There'd be one chipping away at consolidation. And then page 12, still got the $64 million in the Mass Mutual General account, and it's down to 45% of the plan, which at some point it was 48, and I think it's probably by virtue of the equity funds appreciating in value. All right, if you go to page 15.
Do you think it would have had that much of an impact? I'm just stuck on the Mass Mutual General account.
By percentage?
Yeah, probably.
I honestly, I haven't gotten so granular to look at movement within, from the Mass Mutual report, but
It seems to me at one point that general account was right at or over 50%, or was it under? Am I memory wrong?
I think it was as high as 48%.
Okay, all
Yeah.
right, that makes more sense.
Page 15, the scorecard detail, and obviously we want funds to be top 50th percentile 3 and 5 year for investment policy criteria and compliance. Some good rankings here: PIMCO total return, Hartford total return, Putnam high yield, pretty steady, and there's that T. Rowe Price retirement balance that last quarter was in the 49th percentile. It's dropped to 52nd, and then last quarter it was 43rd on the 3 year. Now it's 52 as well. I referenced page 11, where it should less than $16,000. Now, if you go to page 54 and 55, I'll illustrate in the fund fact sheets. You look at this T. Rowe Price Retirement Balance Fund. Top right, expense ratio 57 basis points. And when you look at the top 10 holdings on the middle left, so what this is a fund of funds, okay? So T. Rowe Price is creating their asset allocation by using their proprietary, in-house funds, which is not necessarily good nor bad. And we have exposure to T. Rowe Price because we have the retirement date funds, but if you look at every single fund, whether it's within T. Rowe Price or MFS or Fidelity or Franklin Templeton, it would be almost impossible to have best of class funds in every.
What is the logic between having retirement date funds and then a retirement balanced fund?
That's a good question. And to answer that, if you look at the asset allocation down below,
Mm-hmm.
if you look at the cash, or excuse me, the fixed income, which is the blue, and then the cash, which is the gray, and the rest is stocks. So really what you have asset allocation of is about 40% stock, 60% bonds. So this isn't really part of their retirement date series. This is just if somebody were to be retired at some point in their age, this would probably be an appropriate asset allocation for them. It's going to be static. There's no glide path.
It's really kind of 60-40.
Huh?
So it's kind of 60.
Well, 40 stocks, 60 bonds.
That's what,
Yeah.
yeah.
Stock to bonds and
Right.
that. So now if you turn the page to 55, you've got the Oakmark Equity Income Fund, which there's significantly more money in, and 74 basis point expense ratio. So it's actually lower. And you notice the top 10 holdings, the way they're creating their portfolios by individual stock selection. Okay. And then if you look at the asset allocation, you're looking at more of a between cash and fixed income, you're looking more like 70% stock, 30% bonds. Now, in a fund like this,
What are the categories, the other column, on than the other pie.
Yeah,
It's
you know,
58% other. Right?
yeah, it could be preferred stock. It could be anything, but it's 5.5%.
It says up here.
But you know, in a balanced fund like Oakmark Equity, when you're looking at asset allocation, you know, balanced, you know, with rates so low, there's a lot of these balanced funds are overweight stocks right now because they're just more compelling to own than fixed income. And at some point, it wouldn't be surprising if a fund like this, you know, reallocate more like 60-40. So, you know, back to the opportunity to consolidate, you got 15,001 that's on consent, and Oakmark Equity has 6.7 million in it. Or, you know, would you like to let the process of keeping it on keeping this fund on watch for a quarter or two and just let the process play out? No particular rush, but
I mean, my opinion is that, and I hate speaking first, but is for this is the one that's got the 15 grand in there, 16
Yeah.
grand in it. I mean, it's easier to deal with it now than it will be somewhere down the road.
in the spirit
I
of
don't know.
progress,
Yeah.
yeah.
I mean, I don't know how my members feel, but
It's really a lot of watching for a little low number.
Yep.
Yeah,
Yeah.
Yep.
agree.
How many persons do we know are in that?
You know, it doesn't show in this,
Okay.
and you know that's a question that tends to come up, and I don't want to minimize the question because it's
We've asked it.
yeah.
before, I know.
But on one level, you know, I would say, you know, if a small number of people are in that fund that doesn't rank well, then you're not affecting too many people. But then if a lot of people are, you're positively affecting even more, you know. So.
But
yeah.
because of the amount, if it's a lot of numbers, then it's not really affecting them at all.
Yeah, I mean, usually just looking at the asset values probably makes more sense. It's usually an indicator of participation, but even so, it just can't, for 15,
No.
16 grand, it can't be that many people.
Right.
Maybe we just one of them.
It could be,
They'll send us a thank you letter.
So are we
Retiring.
following the form
Yeah,
process of a
yeah, I
motion?
mean, Ron, so, but let's just, all in favor, I'm not taking the formal vote, but just, you're all in favor, say aye.
Aye.
So, Ron, just for the record, show that the 4 non-quorum members voted affirmative, and the others would follow along. But the reasoning here is that it's not performing, and it's small amount of assets. It's easy to move it right now.
That's a consolidation.
Yeah, it's a so we're not doing a fund search. We're just consolidating it into Oakmark Equity and Income, right? Isn't that where we're putting it?
Mhm.
Correct.
And it's still in the same balanced asset allocation grouping. And then you might just make a note of, they can find both of those on page 15 of this document. Okay.
Okay, so back to page 15. And there is the Oakmark Equity Income in compliance. Then we get down to Hartford Capital Appreciation. Last quarter, it was in the 75th percentile on the 5-year. Put a monitor tag on it from last quarter. It's improved to 65th, and over the 3-year last quarter, it was in the 23rd, dropped to the 24th, so negligible. I would suggest just maintain the monitor. It's below 50th on the 5-year.
I think that's right. They're all
Mutual Select Opportunities Fund, that has a big balance because we've consolidated some 4 large growth funds into that. That's doing well. Hotchkiss and Wiley, that was an added fund. That's doing well. Page 16, Hartford Mid Cap, Invesco Small Cap, fantastic rankings. Small Blend, the AMG Manager Skyline, fantastic. You got your small cap index, fine. Small company, Hartford Small Company, fine. And then we get into the foreign blend, and you got Hartford International and MFS International, and we've kept these 2 in the lineup because they were both doing pretty good and ranking very well. But this would be yet another opportunity to consider consolidating. Let's go to page 11 and look at the balances. Hartford International, you've got 2.7 million. MFS International, you've got $1 million and change. And then let's look at page 25. And 26, and let's compare the actual returns. Actually, Hartford is on page 25 and MFS on page 26. But over a 3-month period, MFS International beats at 6.67% compared to 5.17. Year to date, it's the same number because it's the first quarter. Over the 1-year period, MFS is up 7.22 compared to Hartford, that is up 2.52. And 1-year ranking, MFS is second percentile. Hartford is 15th. And the 3-year number, MFS International annualizing at 13.78 compared to 9.05 Hartford. And the 3-year ranking, Hartford MFS is ranked second, and Hartford is ranked 27th. And the 5-year returns, MFS International annualizing at 11.2%, ranked second, compared to 7.15% Hartford, ranked 16th. You've got a good fund and an even better fund. It's good and better. And then finally, on this analysis,
But it is interesting, though, looking at the basis points difference, though. I agree wholeheartedly with what you just said. I mean, obviously, you can be in the first quartile, you're a good performing fund, but there's a big spread difference between the. Just look at the since inception of the 10-year annualized return. That's a big difference.
Yeah, and it's additional data. I tend to not put that much emphasis on the 10-year. It's so just in the rearview mirror, and it's not really IPS related. But you're right.
But even on the, pick your category. The 3 months, they're at 667 versus 517. That's 150 basis point difference.
Yep.
Right.
Yep.
And then year to date, same number, 517 to the. Where the heck am I?
Yeah. Well, 516. That's the same as the quarter because it's Q1. Yeah.
722 versus the Hartford at 252 for the 1 year. All the way down. It's interesting that the difference in annualized return seems to my eyes significant, and yet they're both in roughly the first quartile.
Oh yeah.
I hate to be in the bottom quartile.
Yeah, a lot of good performing funds.
It seems like there's an opportunity for consolidation there, and maybe we can talk about that with the rest of the group next time.
Okay,
But
and then
I do agree that there's.
So no.
I guess I have.
No
I guess my thought process is just to share with everybody is that not that not that the other fund is performing badly, clearly it's not
Yeah.
compared to its peers, but it still seems like an excuse to make it consolidation and get the one fund, because if that one fund doesn't perform, we're gonna put it on a watch list and change it anyway. It's not like it's lost.
Yeah, and then there's one more bit of analysis, page 67. And 68, so the Hartford expense ratio is 74 basis points.
I have forgotten how to jump to pages.
MFS International's
67?
82.
No.
The slide there. I see what you're talking about.
Probably punching the number right there.
There we go. Gotcha.
I'd rather see one of those funds, particularly the poor performing one. If we're going to have too many foreign funds, replaced with a different class, not a large one, but maybe emerging markets or something.
Well, we also have a global category.
Was that where those are at?
Yeah,
Did I miss
that will give you emerging market exposure.
Where was?
It's not just emerging, it just gives us exposure to it.
Yeah, so on page 67, Hartford is 74 basis points, and you look at the geographic allocation, being foreign, so, technically it would be out of the United States, although they've gone a little out of benchmark, and they do have, 9, almost 10% in U.S. And you look at some analytics of, alpha is a 3.28, that's a very good number. And then on the next page, MFS, got an expense ratio of 82 basis points. They're carrying 11.5% exposure U.S. And then they have an alpha, which is a measure of value-added stock selection, active portfolio management over just being an index investor, an alpha of 8.06, which is extremely high. So something to carry over for next meeting.
Yeah.
And then,
I can't retain it from quarter to quarter.
and then American Funds Capital World Growth and Income is on watch. 2 quarters ago, on the 5-year, the ranking was 65. Last quarter it was 62, and this quarter it's 52nd. So it's made steady increases, steady improvement. And on the 3-year, 2 quarters ago it was 29. Last quarter was 32. This quarter is 27. So it's continued to improve. So I would suggest keeping on watch. Still below the 50th on the 5-year.
One sec, Freddie.
American Funds Capital World Growth and Income.
The arrow down.
Yeah, that one.
Hey, Mark, is that something that we need to, we've been reviewing the plans a lot. Do we need to have in the agenda that conversation again of, we were really focused on the first year, looking at bad performing funds and consolidating, and now we still want to continue with consolidation. Do we need to have that conversation when we have enough representatives?
I think so. I mean, the Freddie can speak to this obviously better than I can, but I think the data shows that the more choices we give our employees and beneficiaries, whether it be between 3 different plans or within the plan, 30 funds versus say 20, the more choices we give, the harder it is for employees to make, for the employees and the beneficiaries make those investment decisions, and unless they get good counsel, oftentimes they don't. I mean, the data shows that the more you offer, it doesn't translate into higher investment rates, I think.
Well, yeah, and it's there's a lot of studies that say if you give two people too many choices, they'll just get flustered and walk away and make no choice, do nothing. And
so the question becomes, by reducing the number, are degrading or somehow diminishing their ability to, to get into markets that they want to get into. And when we have these duplicate situations, I mean, it's hard to make a case that we're diminishing anything.
Yeah,
Right,
when
and
you
I
talk
would-
about,
yeah, and
go
like
ahead.
I said, I would like to at least have the conversation again, because these are valid points. We have consent items, things that are definitely going on watch, but that doesn't mean that we couldn't or we still shouldn't make another decision on some things. But if for the first year we were always looking for things that were on watch, then our work is done at this point.
Right,
But-
so we have less that's in wash, and we have stuff that's sort of, we've dealt with all the low-hanging fruit.
Correct.
And
Yeah.
so I think what you're saying is that maybe it's time to roll up our sleeves and go another level deeper.
Go another level deeper.
Yeah.
We're getting ready to
Yeah.
hopefully have another Palooza where, and I think that helps a lot. How many people learned last year and how many will learn this year will help them a lot. So.
When you look at this, this shows that, if there's an area of the market that you want access to, there's vehicles to access, broad market exposure. But if I'm a participant, we're talking about maybe consolidating the two international funds into one.
Mm-hmm.
If I'm a participant, a big challenge in being employed with the city, you get first of challenge is finding what record keeper you want your assets with. You got 3, so that's the first challenge. Regardless of that, then you want to have a reasonable asset allocation that makes sense for you. Balance between stock and bonds and growth and value, blah, blah, blah. But if you decide you want an international fund in an asset allocation, well, now you got to decide between 2. Now that's getting, pretty dicey. So, most of the plans well, really virtually all the plans that I've worked with and other, plans that I've researched, the large gaming companies that have consultants, that have seasoned committees, it's almost unheard of to have more than one choice in an asset category because, make it easy for a participant and let the participant rely on decisions at your level, the committee level, to vet these issues and put the most compelling, investment option in each category and take that one less decision out of it for them. So.
Correct.
Thank you.
Well,
I would rather have good choices.
I would rather have good
Too many,
choices.
but I just want to make sure we should
Sure.
because at one point I don't want to finger pointing and say, well, everybody tells me to invest in international stocks and fund you pay some for reporting something that's off the watch list. And I didn't make a choice. My advisor was thinking 10%. Something like the international fund, I'd rather have a few extra choices than. That's one area. I mean, in a large domestic fund, okay, so be it, they're going to track.
Well, continue on page 16. You got Hartford Healthcare, we're doing fine. Page 17, Memphis Utilities and the real estate, which is a new fund we added, doing extremely well. And you got our target date funds. So, it's not perfect, but I think for the most part, we're in pretty good shape with these funds, the rankings, and performance.
And we do have one recommendation sort of sitting on the book, so we already talked about.
Not for Mass Mutual. There's a fund search for ICMA and Nationwide.
But we talked about the T. Rowe Price.
Oh,
Yeah,
excuse me, the consolidation.
Right,
Yeah,
that consolidation.
yeah. Moving down the agenda items under Mass Mutual, I'd like to share my experience in kind of the final. You never know it's a final, but in the most recent iteration of the Mass Mutual general account discussion, in your black folder, you'll see this piece that I put together. And, so we went to New York, we went to the awards event, and then the next day, we went to a meeting at Mass Mutual. It was actually pretty darn impressive where, Mass Mutual, if you ever been to New York, all these states are, close together back there. And Mass Mutual is in Hartford, Connecticut, where the insurance company, because remember, by legacy, they're a huge insurance company, but then they've got the retirement services operation a 20-minute drive from Hartford, Connecticut to Enfield, Massachusetts. So we fly on this corporate helicopter, a 45-minute flight across the Long Island Sound, and with a couple other people, that were going out for various reasons. They had this thing going back and forth all day. They had like 2 or 3, yeah. And so, we land there, and then we, get in sedan and drive to Enfield, Connecticut, where we go to the retirement services, operation, and it was really impressive. They start with giving this big history of Mass Mutual, and started, as an insurance company, and talked about, they run their business. They're not a public company, so they don't have to manage their operating, results, and report quarterly to appease analysts. It's a mutual company where the insurance policyholders are beneficial owners of the company, and have gotten endless amount of dividends to their policies over the years by virtue of good performance, so they can manage their company for long-term results. It gives them some operational advantages. And we go on and tour the different parts of it. And we tour the the call center and work, and they have a whole specialist that talked about the culture, and it was significant. It was very impressive. And we get in the conference room. There's a number of different agenda items, and I told them in advance that we wanted to talk about the general account and for transparency as much as they could give, but also within the context of pricing and with the benchmark report. And I talked about the 65 basis points attached to $64 million. Huh?
And they choked.
They choked up a gizzard.
65.
Yeah. And
You made that up.
and they said, they understand the thought process behind that. And I said, because we have to try to create a level playing field, and this is what fiduciary benchmarks is assigned to the general account. And they said, well, we have to disagree because, if you were in a registered or a stable value fund like you have an ICMA where there's quantifiable, expense ratio and everything, it's an expense ratio type of, vehicle. But in the general account, it's what's called a spread product. And I was always, my first thought was, of course, they pay, Citi 4%, and everything they keep the rest, and they don't have to disclose what it is.
Assuming
Okay.
there isn't.
Pardon me?
Assuming there isn't.
Well, there you go. So.
Because that's what they're telling.
Right. So here's what they said, and it was, and let's also put this in the sort of the educational, content of what the committee would like to have, a little education with every meeting, and this is educational for me. So you assume 138 million in plan assets, where 64 million or 46% is in the general account, and then 74 million, 54% of the assets are in what they refer to as the variable investments that people can invest in the fund, the other funds, the growth, value, bond funds, whatever that's in the lineup, where you can quantify the revenue sharing that's in the benchmark report. Every of those funds has a quantifiable expense ratio and a revenue share of the record keeper. So assume if a general account portfolio, let's say it's a duration of 5 years, an average maturity of 7 years in the portfolio. So you take the 5-year treasury, which they've come up since April 1st, okay? But at that time, it was around a 137. You take a 10-year treasury rate, there was a 194, and if you add those up and divide by 2, let's call a 7-year treasury rate of a 165. But we know that rates are very low in treasury bonds. You can't really run a portfolio that's going to generate any kind of yield just owning treasury bonds. So you have to invest in corporate bonds and mortgage-backed securities that come with higher coupons, okay? But they also come with a risk premium because they're not backed by the U.S. government, okay? So you need to be rewarded in that. So that risk premium is what's commonly referred to as a credit spread, an incremental yield you should be able to earn in these corporates or these other types of securities over and above a treasury bond. So the credit spread at a 5-year is roughly 164, 10-year 270, add them up, divide by 2, you got a 7-year credit spread of a 217. So you take the 7-year treasury of a 165, add the 7-year credit spread of 217, and you get a portfolio yield. What the portfolio could earn is a 382. So Mass Mutual's on the hook to the city of Las Vegas to pay out the 4% crediting rate.
But this is a mathematical exercise not based on what assets they're really holding in that account, right?
Right.
'Cause-
But we don't know. There isn't enough transparency.
That's my point.
Yeah, but
I mean, you're going through this exercise to say, well, if this and if that, then, they're losing 18 basis points. But at one point, I remember a year and a half ago, whenever it was, when we were kind of dealing with the RFP, we saw a document that indicated, that they had a pretty high weighting into high yield corporate bonds. So I don't know where the high yield corporate bonds fit into your credit spread, but I'm trying to remember. It seemed to me it was like 10% plus or minus something that they have in high yield corporate bonds. Do you remember that?
yeah, I mean they have.
My point only is really it's just verifying what you just said is you're going through an exercise that would assume some things here, but we don't really know.
We don't know for sure.
And one of the concerns that we had, maybe by way of education for the group, is that two things. One is we assume 4% is guaranteed, it's safe because it's a big old insurance company. And of course, we had that whole discussion about Hartford back in 2008, 2009, so we understand that they're not always entirely foolproof. But yet, the other issue is that based on what we know, and you're proving it out here, based on what we know about what the current yields are, they can't hit 4, and without taking on more equity-like risk in some form, shape.
Yeah.
Like high yield bonds.
Yeah. Well, according to this, and I did not put this in, but it came out last quarter. This is as of fourth quarter, and this would indicate there's about 7% in high yield.
Got a call from Julie Heddle.
Yeah.
She's on bereavement this week.
Okay.
That's the way.
No problem.
That's why she-
Thanks for letting me know. Yeah. Thanks, Mike.
So anything but below a triple B is non-investment grade. So you got 3.7 double B, 2.5 in B, triple C and lower 1.5, and in or near default 0.6. So
What's that out of?
7 or 8%.
Yeah, so 10% plus or minus.
So-
anyway,
Yeah.
my whole point was just because something says it's,
Yeah. Well, and I'll tell you what, Mark.
just
but-
because somebody says it's a fixed, it's a bond, it's a fixed rate, it isn't necessarily accurate.
Right, but to your point, support of your point is in this composition that indicates long-term bonds of 56%. So that that could equate to a duration or an average maturity more than 7 years.
Right.
But this is what was
Okay.
represented
Got it.
to me.
Yeah, this is how they made their argument.
And so when you talk to Bob Trineri, this is the whole lead into the benchmark report, I said, can you tell me what your required revenue is? And he said, well, we've been through this discussion before, but if you had a bid on a plan today, you would have to to state a required revenue, they get laughed out of the room. You have to quantify what the required revenue is. And he says, but we make 15 basis points on your plan. Now, if you go to the bottom of this, skip the second to last bullet point. So he says if they make nothing on this, 64 million times 0 is 0. The 74 million, they making a weighted average of 28
What you're saying
basis
is they gotta
points.
make 207 to earn their 50 basis points.
Yeah.
That's what you're saying. No
So-
matter how they do it, they gotta make 207 somewhere.
Well, and that's going to be 74 million at 28 basis points, the revenue sharing on the variable investments. Okay, so that comes out to 207 divided into the 138 million assets is a 15 basis points. Now that's their sort of their stock answer in today's low interest environment. We don't make anything on the general account now. And I'm in this meeting, and the person, and everybody's giving me the explanation. It was still a little murky, and they bring in this guy, and he ran me through this, and it just intuitively, the world kind of opened up for me. And he says, the 15 basis points would probably be generous because, that's what we tell people, that we don't make anything on the general account, but we've never been challenged and have asked to provide the level of detail that I was asking to talk about. So they said, in this scenario, they said they're negative 18 basis points on the 64 million, which is a negative 115,200. 207 on the variable comes out to 92,000 divided into 138, to where their profitability based on this representation is less than 7 basis points, which you could, and if it's true, then you could probably conclude that within MassMutual's big book of business, the city of Las Vegas is probably not one of their more profitable.
But we can't
Plan.
because of the 4% guarantee for life.
That's it.
That's the
The
problem.
floor.
Right
Floor.
now,
Yeah.
it's not going to be profitable.
Yeah, and so, if they were bidding on a plan today, obviously they're not going to be offering 4%.
Well, they
It's
have
unheard of.
the plans that we know that they won awards
Yeah.
on. They're not at 4.
So,
What are they?
if they're
They're
crediting
three.
2,
Three, front around 3.
if they're crediting 2 or 3, then they're on the positive, or if they're, then they're on the positive side of the spread. So anyway, it was interesting, and then when I got back, I ran this and had a follow-up call with Jeff Stein, our stable value analyst, and he said this scenario is valid. You still don't have complete transparency on the real portfolio composition, but Jeff always, emphasizes that that's the trade-off of getting a great rate of 4%, and the trade-off is for a lack of transparency. And then the other item was, my intention was to ask them about, talk to us about the contract of the 12-month put provision that's in this, that got amended instead of the market value adjustment, and unfortunately we ran out of time and never got to talk about that. But Jeff Stein said if it ever came to a decision to really take action on this, there's another Morgan Stanley consultant that won close to $1 billion retirement plan, and they had a lot of money in some sort of a stable value fund that they weren't completely comfortable with, and Jeff Stein is actually helping them restructure that. So if it ever really comes down to this, to where you're going to change record keepers or do an RF, whatever, I will get Jeff Stein involved as an absolute subject matter expert to help us navigate whatever scenario comes up on our behalf. So
Good.
So that's my report from the MassMutual meeting.
And is it basically a loss leader for them, like a grocery store selling something cheap to get you in, so they can manage your other money, maybe jack up the fees on the actively managed funds? Are they increasing the management fees on our actively managed funds to sort of compensate for this premium interest rate they're offering on the fixed account?
I don't think think so, because these funds, a lot of these funds have been legacy funds for a long time. And the 4% crediting rate in some environment was just fine for them.
Oh, sure, they were me.
Yeah, but look, rates are on the rise, and at some point, if rates can get up to where they could take and we talked about the different scenarios, and they could take it and offer it to another plan, or not have to pay 4%, or if it gets if rates get generally get above 4%, that might be an opportunity if it ever came down to it to displace this investment with less strife.
So do we know what the 5 and 10-year treasury was about 10 years ago?
We entered into this. You talk about when we entered into all, well, that was.
Oh,
Well,
I could probably research
the
it.
bond.
No, I was just curious if you just happened to.
No, I
was
wouldn't know it
curious
offhand.
or approximate
But
or
I
something.
would venture to guess a decade ago it was higher.
Yeah, it was higher.
It was
I
much
mean, there
higher
was a
because
time
of-
there. There was a time there when treasuries were, geez, what, 7, 8%. I mean, you had to be an idiot if you couldn't make 10%,
Yeah.
practically, and you were embarrassed if you weren't making 20.
Mhm.
But there was a long period there where they were historically high.
Yeah. Well, actually, the just this week with all the discussions about the Fed raising rates, and Marco was because they are going to raise rates, maybe in September, probably in December. It's going to be the first rate hike in 10 years. So that takes you back to 10 years ago. So, rates are relative. If you're an investor, you want to collect high rates. If you're borrowing, you want to pay lower rates. So, yeah. You guys know that. Yeah.
All right, I think that was helpful. Maybe makes us feel a little bit better, but
For you guys,
still not as transparent as everything else.
conversation is too long. If rates go 5%, say,
Mhm.
the amount of interest generated for investors versus the amount of increased interest paid by consumers on various
Oh,
debt.
yeah, you bet.
How does that balance out the economy with the investors expending the money? I know a lot of retirees that have to go back to work because their fixed income CDs pay nothing.
Right.
Whereas if they were getting 8%, they could comfortably spend that money, without having to even work. And how does that play in the overall marketplace relative to people paying more for mortgages and car loans and consumer debt? Have you ever seen an analysis of that?
I'm sure I have at some point, and I think it figures into economists, looking at and projecting, GDP growth.
And we've seen that
Yeah.
it depresses spending.
Well, it's the same thing that Vanetta deals with all the time, because we actually have our own $500 million investment portfolio, right? But state law prohibits us from investing in anything but fixed income. I think we can go to AAA corporate, but most of it's treasury, huge treasuries. And it sucks it in.
Yeah.
But it's also a good time to sell debt. Right?
Yeah.
So
Issue
it's,
debt.
It's
Yeah.
issue debt. Yeah.
Yeah.
So I mean, it works for us just as it works for the consumer. Rates are high. Yeah, you can get a decent CD, but guess what? Don't finance anyone.
Right.
And when the rates are low, it's the opposite. So,
And it's a good time to be.
my own personal. This is just my own personal. I suppose you got to be where you got to be, based on. You got to do what you have to do based on where you're at. But for most of us that have an opportunity to defer our income through these defined contribution plans, shouldn't be in CDs. Yes.
Right.
It's stupid. Right? So I feel bad for those folks that are stuck out there with cash that they want to put it someplace safe and secure because of their age and all that, and they need liquidity, but still, they don't get anything for it.
Yeah. And that's why, that balance fund, open market income, is overweight equities right now. I can't say specifically, but the yield on the S&P 500 is probably somewhere around 2% of just the stock dividend yield versus a 217 on the 10-year Treasury. So it's also a good time to issue debt, but also I'm sure you take advantage of any times like this to refinance existing debt.
What do you think, Vanessa?
I
Do you
think
take
it's a good
advantage of that, do you?
plan.
You bet.
Yeah, good. On to ICMA.
Q1 250.
Yes. Page 17. I'm sorry, Ron, page 7. Is our watch list. And this looks like 5, but it's really 2, because the Vantage Point model portfolio traditional growth was mapped to the target date funds on April 17th. So it was, we're reviewing Q1, so it was in the lineup during that Q1 period. Vantage Point model portfolio all equity growth, same thing, mapped on 4/17. And down below, the model Vantage Point model portfolio long-term growth was mapped on 4/17. That leaves the two watch list items are Vantage Point equity income T, which I have a fund search for, and the Vantage Point milestone retirement income, which is the most conservative fund on the target date fund lineup. So, they come as a set, so it's not like you're really going to take action on it. So if you go to page 9, as of 3/31, there were 35 funds, and on 4/17, after consolidating 4 of the risk-based asset allocation funds, there's now 31. Okay. If you go to page 12, here's the plan composition, plan investments, and in the balanced asset allocation category, 3 of those 4 funds have been mapped, and then the equity, that Vantage Point model portfolio all equity is also have been mapped. And then on page 13, I should also just point out that the Vantage Trust, the 3-year CD, $1,235 was also frozen, so no new investments can go into that. And then when whoever owns those CDs upon maturity, they will be mapped into the stable value fund. And on page 14, as a 3/31, almost $50 million for the ICMA. And for the rankings, under the scorecard detail on page 22, the Vantage Point Inflation Focus T was removed from watch list last quarter, and the fund can, because it's improved and improved top 50 percentile, and that is even improved further. Last quarter, the 5-year was 43rd percentile, improved to 38th. 3-year was at 42nd, improved to 32nd. So that trend continues positive. There's our Western Core Plus Bond Fund. That's a new fund put in. Rankings are great. And last year, that portfolio manager team was Fixed Income Manager of the Year by Morningstar, a Morningstar award. Vantage Point model conservative portfolio. You can draw a line through it. That's mapped on 417 to the target date funds. Vantage Point traditional growth mapped on 417. Long-term growth portfolio was mapped on 417. And we get to the Vantage Point Equity Income T. And this has been on, this is on the watch list. Last quarter on the 5-year it was 63rd percentile. It did improve to 61. Or let's go back 2 quarters because it's been on watch for that long. It was in the 55th percentile, decreased to the 63rd, then improved slightly to the 61st. On the 3-year, 2 quarters ago, it was 65th, improved to 64th, and then declined to 70th. And with that, I will show you a fund search that is in your black folder. And this fund search, we're in the large value category. And I believe there's about 1.2 million. I'll verify that. Vantage Point Equity Income T has $1,249,354. And so three very attractive candidates here. American Beacon Bridgeway, Federated MDT Stock, and JP Morgan Value Advantage. And you see the rankings on page 5 of this, stand out against the stinker that Vantage Point Equity Income has become. On page 5 or page 6, you can see for the quarter, American Beacon is the best at 173. Also year to date, because this is Q1. 1 year is the best at 12.12%. 3-year, 19.35%. Over a 5-year period, 15.62. There's the rankings again, 1 and 2 for 3 and 5 year. And then when you look at the risk measures, which I always put a big weighting in, you're looking at, you want a high alpha, you want obviously the lowest beta, and a beta, beta is a number of risk or volatility, if you will, compared to the benchmark itself, compared to the Russell 1000 Value Index. So you want a low beta. You want a high Sharpe ratio, which is a measure of unit of appreciation earned for unit of risk taken. You want a low standard deviation, because that's going to be, how much does the fund itself deviate from the annualized, mean average returns. And then R squared is a measure of, if the R squared was 100, that means, how much does it resemble the index itself? So you may as well, if it's 99.9, you may as well just own an index fund and save the expense if it's going to look that much like an index fund. But sometimes to be different and to outperform an index, you need to do some different things like overweight sectors and have different stock selections. So if you go to American Beacon Bridgeway, a very high alpha of 230, although not as high as JP Morgan. The lowest beta, it doesn't have the 120 Sharpe ratio that JP Morgan does, but it has 119, and it has the second lowest beta in the group. Style-wise, American Beacon has outperformed the benchmark peer group over the long-term and recent market cycle. When they're constructing a portfolio, they're going to screen the 1,000 stocks that make up the index universe, and then they're going to look at the 3 stock selection models. They look at value metrics, they look at price momentum, and they look at companies' financial health, and then they ultimately select a portfolio of 70 to 100 stocks. And as a sidebar, Bridgeway, which is a sub-advisor, they donate 1/2 of their profits to 3 things: world peace, human rights, and genocide. If anybody's interested in that, but the Federated, also a very high-ranking fund, good-performing fund. Again, screening 100,000 stocks in the index, score against 10 key factors for value growth and quality, and then they assign these values to quantitative models. So it's almost like a bunch of, math whizzes in a back room assigning values to different metrics that, from a computer program identifies from 110 to 120 stocks that would be in their portfolio.
I've asked this question before, and I can't remember the answer, but I think I understand what it has to be. When on page 6, when you look at American Beacon,
Mm-hmm.
We've got a 10-year number, but then we also have an inception to date, right?
Yeah.
And so I think this has popped up before because I'm looking at the inception to date on.
Yeah, it doesn't make
any sense.
Right. Yeah, that might be for the share class.
And of course, you see that with Vantage Equity Income T as well, which is, I think it's come up before, and I can't remember what the answer was.
The inception date is the date the fund was formed and became available for sale to investors.
Yeah, so that would indicate the share class, because this is specifically the investor share class.
So that would mean that my performance beyond the inception date of the share class includes performance outs in a different class.
That's right.
Yes, right.
And on the fact sheet, it talks about the manager tenure of this manager of 11.42 years. But
So what's even more impressive then is the since inception, it's going 19.94 compared to the others. I mean,
yeah,
it's hard to say, how the others are performing since you would say like 3/1/2013. You would like to have that comparison.
yeah. Let me clarify that, Mark. Let's see. Now the J.P. Morgan, is also very attractive, although the only thing that makes it a little less, I'd say, it's a very good fund, but J.P. Morgan screens into the Morningstar large value category, but when I spoke with J.P. Morgan, they sent me some of their information because it's not as going to be as pure of a large cap value fund. They can buy some mid and small cap companies, and some of their benchmark internally they should compare their fund to more the Russell 3000 value. Although the asset allocation today is certainly primarily large value. My hesitation would be in the future when we compare it, it's just going to inherently come with some inconsistencies and make it a little squirrelier.
So saying it just maybe a different way is that when we have funds that maybe are performing on the boundaries of their this asset classification, that and let me just say, maybe in this case, in order to take a little more risk to have a little bit of performance against the index,
Mm-hmm.
then they're not really acting pure to the category that we have them measured in. Like maybe they belong in a different category, and so I mean we want to make sure that what we've got in our boxes in terms of large to small
Right.
and valuable to growth are
Yeah.
properly classified. That's one of the things we ought to be careful about.
Right.
I think is what you're saying.
Yeah, that's true. That's absolutely
Because
true.
otherwise we're misleading people in terms of what box we think they are performing in, despite what the fund says it belongs.
Right. If you're making if a participant is making a conscious asset allocation decision and trying to identify vehicles to fill that asset allocation, and one of them that represents itself as a large value is mostly large value, but also mid value, maybe a little small growth. When the markets get volatile, those smaller capitalization structured companies, usually are much more volatile. So they're going to have. That said, it does have a relatively high R squared, but that's today. But again, I think we could just avoid some potential challenges in monitoring this fund, in a pure sense to a benchmark when we have two other good candidates that we wouldn't have that problem with.
Well, and that's outperformed everything from 5 years down. So.
Yeah. So.
And their expense ratio is about the same.
Yeah. Now, speaking of expense ratios, on page 7, we are going from a fund that has expense ratio of 53 basis points, but I always say don't compare cost with value, because in this analysis there's more value paying a higher expense for a much better performing fund. So American Beacon is the highest at 110, but if you look at the rank in the category, it's still, and this is not necessarily investment policy criteria, but here's the data that does show it's still in the above the 50th percentile in terms of cost in that category. So to me, the American Beacon is very compelling, and I want to open it up for kicking around discussions and maybe make an informal
You guys have any thoughts?
4-person vote.
A little bit of a toss-up.
I'm just wondering, because of the cost, if J.P. Morgan value advantage.
When I look at the 1 year, American Beacon beats J.P. Morgan by almost 100 basis points, and the 1 year beats him by almost 200 basis points, and the 3 year, even in the 5 year, beats him by 34 basis points. Right. So I'm asking myself, is that 34? Do all those basis points beat the 8 basis points difference on the expense? They certainly do. But
What I was hearing before, J.P. Morgan isn't necessarily the purest of this type of.
Yeah, that's right.
So we might give it a little extra points for that
Right.
in our minds.
I mean, the Federated has very good performance as well, but when you look at the risk measures, which is,
very low alpha.
it's a kind of tells the health of the fund. So it's a lower alpha. It's positive, but significantly lower. 12% more volatile than the index at a 110, 112. Sharp ratio is not higher. It's not as high.
Well, if I were to throw a coin, I would say the fact that it's more representative, if I can say that, of the category, and that it's performed better on the near term, 5 years and out.
Certain stock holdings of the American, they seem a little more aggressive than the JP Morgan. JP Morgan looks like just a large, like a large equity fund. You look at Wells Fargo, Exxon, Pfizer.
Yeah, well, I would say, if you want to look at, you say more aggressive?
American Beacon seems a little more aggressive and
Yeah.
performing better.
Yeah, and I think you could, if you want to try to quantify that statement of being more aggressive, I think you have to go back and look at, beta and standard deviation. So, American Beacon has a beta of 0.95. Were you compared to J.P. Morgan or Federated? J.P. Morgan is a beta of 92, so marginally lower beta. But the standard deviation is a little lower in J.P. Morgan as well. So that kind of validates your observation. But you get back to the alpha, which is very similar, and Sharpe ratio is similar.
I think American Beacon, just for the fact that it is keeping true to the category, better for us, I think. Good scissors are close. American Beacon.
So what do we do, just
No.
Make
Your-
an advisory
make a-
recommendation.
Yeah, I mean, John, do you still kind of up in the air?
I'm
No,
American
all
Beacon.
Beacon.
Okay, so Ron, let's just record show that all four of the sitting members here are in favor of American Beacon being our recipient of the
And that was 1.2, 1 point.
Yeah, 1.2.
of the Russell. What is the Russell 100 value?
Yeah, we're replacing the Vantage Point Equity Income T.
Okay, I'm sorry, yeah, there we go. And so that's, so the Vantage Point Equity Income T is on page 22, and I don't know that this wasn't in the Dropbox, and you might have to.
Oh, it was.
Was it? in
Oh,
the
let me
Dropbox?
see what you have there, Mark.
This is.
Oh, yeah, yeah.
Is that in the Dropbox?
Yeah.
Okay. And
Do
it's,
you want me to double check?
just go back to your file folder.
I see my fund search, yeah.
There you go.
Okay.
So that's, you can just reference page 6 of that document on the fund search. And page, okay.
Okay, back to page 22, scorecard detail. Get down to the Vantage Point model portfolio all equity growth. That was mapped on 417. Page 23, Fidelity Contra Fund, large growth. We had a monitor tag from last quarter. But it's doing pretty darn good. It was 2 quarters ago, it was on the 27th percentile in the 5-year. Last quarter, 34th. And this quarter improved to 28th. And on the 3-year number, 2 quarters ago it was the 50th percentile. Last quarter was the 51st, and this quarter improved the 40th. So, in my thinking, we can remove the monitor the monitor tag, it's out of harm's way right now.
Yeah.
Makes sense.
It's Vantage Point Select.
Fidelity Contra Fund?
It's that Fidelity Contra Fund. It was unmonitored, but or on watch, I guess. Our policy was if it goes on watch on consent, that we have to vote to take it off watch, even if it's performing better. So.
Yeah, but just to clarify,
Right.
it was not on watch.
Was it?
It was not on
Even
watch.
at 50, it was.
It
just
was
couldn't monitor.
very close.
All right.
Yeah, and it was only on
So we don't
below,
need to do any of that.
and it was only on the 50th,
Yeah.
just on the 3-year.
So if it wasn't on watch, you didn't do it. All right. We agree.
Okay. Vantage Point Select Value T had a monitor tag on it on the 5-year, which was never an issue. 2 quarters ago, it was in the 31st percentile. Last quarter, it dropped to 45th. This quarter, it improved to 32nd. 3-year number was the issue. 2 quarters ago, it was in the 54th. Last quarter was in the 63rd, and this quarter, it marginally dropped to 64th. So I think you have to maintain monitor by virtue of the 64th on the 3-year.
2 quarters getting worse.
And anytime you see a Vantage Point, that's a proprietary fund of ICMA. So. The AMG Times Square mid-cap growth was also had a monitor tag 2 quarters ago on the 5-year. It was in the 46th. It dropped to the 57th, and this last quarter improved to the 49th. On the 3-year, 2 quarters ago, it was in the 15th, dropped to the 34th, and this quarter it improved to 30th. With the fact that it's above 50th on both, I think it can remove the monitor from that.
Agreed.
Harbor Mid-Cap Growth Fund also had a monitor tag on the 5-year number. 3 quarters ago was 57th percentile. Last quarter, or 2 quarters ago, it dropped to the 60th. This quarter, it dropped to the 62nd. And on the 3-year, never a problem. It was last 3 quarters 42, 16, and now 39. But I think you have to keep it on monitor because of that 5-year.
That one, just to throw it out in the table, since we have 2 funds in that mid-cap growth category, makes you wonder at some point, do we wait until both are, or do we do it sooner? Just
What was
thought.
the performance of the AMG last quarter?
Well, last quarter it's improved. In fact, it's improved to where we just removed the monitor tag. But Harbor, you're talking about Harbor or Times
He's
Square?
comparing Harbor to AMG.
Yeah, the AMG on the 5-year 2 quarters ago was 46th. Last quarter was 57th, and now it's improved to 49th. And the 3-year number 2 quarters ago was 15th, and 34, now 30. That'd be a situation where, still in the 49th percentile or 5-year, neither of them are star performers. It would be, in a perfect world, one would be so good you could have confidence consolidating into it. But in this case,
Easier, yeah. This way
maybe
you
next
almost
quarter,
want to do a new search,
a search, yeah.
which is really your point, right?
Yes.
But would you like me to do a search for next quarter, or just give it one more to evaluate?
I think I'd like to see a search.
Hmm?
I said I'd like to see a search on
Okay.
this one because it's
Yeah,
they're kind of both.
yeah, they're both somewhat marginal.
Yeah.
read this way, the one like the way they read this way. So
Same thing.
non-stellar and marginal are two good terms.
Moving down the list here, Vantage Point Discovery, fine. Oppenheimer Discovery, fine. In the foreign blend, Vantage Point Overseas Index is okay. Fidelity Diversified International, doing fine. And then the specialty sector funds, the real estate fund, doing fine. Page 24, there's the target 8 funds. You see where it's referenced before. Staying on watch as a milestone retirement income. Now you have to remember that, these funds are the more aggressive, the glide path through retirement. So you have to, assume that the earlier dated funds are, loaded with fixed income where equities have done better. Intuitively, they wouldn't rank as high. But other than that, these funds are doing just fine. Okay?
Yep.
Brittany, how you holding up? Okay.
Got any questions?
She's already planned for
There are
retirement.
no stupid, questions. Yes,
That's
I
what it
already
tells
showed her-
you.
I already tried to show her my spreadsheet, which I couldn't find because it's at home. It's probably my flash drive now. I think about it.
Okay. On to Mass Mutual. I beg your pardon.
I
On to,
see.
on to Nationwide.
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 There's a new sign. Can't get that stupid commercial out of his head. Hmm?
Hello, Peyton
Peyton
Manning, when he
Manning.
does that commercial.
I do have one question. So
Sure.
each report that you're getting are on 3 different funds, but then the
Three
line
different
items,
plans.
3 different plans, okay. And so the different lines you're going through are the funds within the plans? Okay.
Yeah. It's the same.
Don't ask why we have 3 plans.
I tried to.
Not allowed to ask that question.
What's even,
Yeah.
what I did today, what's even dumber is this particular one, Nationwide, we actually allowed it to be written right into the collective bargaining agreement, so we couldn't consolidate with something else without
Mark.
the union approval. They're not gonna listen. And they know, that's the issue, so this one's written right into the collective bargaining agreement. And it's sponsor, if you will, is International Firefighters.
Okay.
So we could consolidate into it
Yeah.
if Nationwide would, and I'm sure they would be happy to take
Yeah.
everybody. I mean, so it could go the other way. Right? It's a one-way street.
That's right. It was mentioned, last quarter, maybe interim meetings. I was talking to Bob Connolly and Ron, and somebody had brought up the idea to say, why don't you allow all the city employees to give them a chance to invest within Nationwide if they wanted to, and of course, that'd be a windfall for Nationwide to get additional flow. But to me, it seems like it would take a complicated situation and make it more complicated when you've got, trying to referee if, who has a loan out with one record keeper. It's just there's going to be more moving parts, and
I'd be willing to say that if we did open it up, that it'd be so very little movement, because I don't think we see a lot of movement even within their own plan.
it'd probably be a non-event.
Yeah.
Yeah.
A fireman can conceivably be in all 3 plans, right?
Mm-hmm.
Yes.
Yeah.
And I know we have some that are in at least 2. I
I know
don't know
2.
if I remember any that were in all 3, but it's paranoia for you.
Okay. As Ron has queued up page 7, the executive summary. Here's the watch list that reads 4, but it's really only 1. You got the American Funds Capital World Growth and Income, American Funds Capital World, Growth and Income Fund is on watch. The 3 funds below it were mapped on April 16th. The Oppenheimer Value was mapped to the Delaware Value Fund. The Nationwide Growth A was mapped to the T. Rowe Price Growth Stock Fund, and the PIMCO Total Return was mapped to the Western Asset Core Plus Bond Fund. Page 9. On 331, there were 29 funds, and after the 416 mapping, there was 27. And the reason why we only had a reduction of 2 is because in 2 of the categories, when we consolidated, and here's again a little bit of a committee sort of dissension and not all going on the same page, is that, Rusty, in some of these situations prefers to have more selections within asset classes. So just another, challenge when we're trying to make group decisions. But
and from my perspective, because it is a IAFS sponsored plan, it seems to me as long as the funds are performing, I give him that leeway.
Yeah.
If the funds weren't performing, then I think we all have a fiduciary responsibility to say, now you got to find something else.
Right.
I think that's why we got to look at this one.
Yeah. And so, in the bond category on page 9, the PIMCO Total Return and the Eaton Vance Build America Bond Fund was mapped to the Western Asset Core Plus on 416. Within the T. Rowe Price funds, of course, they were added to be in compliance with the QDIA selections. You got the T. Rowe Price 2015, 20, 30, 40, and 50. You got the Nationwide, this balance, this Nationwide Portfolio Completion A, which has a 0 balance, but it was mapped to the Western Asset Core Plus. And then in the value category, large value, Invesco Growth and Income, and Oppenheimer Value A was mapped to Delaware Large Cap Value. And then the large growth, you've got American Funds Growth and Income, you've got Nationwide Growth, Neuberger Berman, and T. Rowe Price Growth Stock. Those 4 funds were mapped to the T. Rowe Price Growth Stock Advantage. So of these 4 incumbent large growth funds, the T. Rowe Price Growth Stock was a good performer, but in mapping, Nationwide was nice enough to offer us to be mapped into the T. Rowe Price Growth Stock Advantage share class, which is at least less expensive share class. And then to facilitate Rusty's preference for choice, we also added the T. Rowe Price Blue Chip Stock Fund. So that's what I was telling you. We moved 4 funds, but only had a 2-fund reduction in the number of funds. And then page 12, here's the composition by assets in the funds. As of 3/31, but again on 4/16, some of these funds were mapped. Page 13. Interesting to point out that now 24% of the 31 million with Nationwide, 7.5 million is in the retirement date funds because they were added, but then we mapped the risk-based asset allocation funds in there. And speaking with Bob Conley, he's a real advocate of using and promoting target date funds, and it's hard to disagree with him because for the most people that are trying to manage their own investment portfolio that may not have the level of precision versus being in a diversified fund with a glide path, probably going to have a better outcome in the target date fund approach, but that's a preference of Bob Conley. And it's hard to disagree. Okay, page 16, scorecard detail. A lot of these red boxes are no longer. PIMCO total return mapped, Eaton Vance Build America bonds mapped. There's a BlackRock high yield doing just fine. In fact, we put that fund in there. Nationwide completion portfolio mapped. Invesco growth and income A mapped. Oppenheimer value mapped. In the large blend, and here's a situation that is appropriate. In the large blend category, you have one actively managed fund in Fidelity Advisor Diversified, and then you have an index option for people that prefer a lower cost option. American Fund's growth and income, Nationwide Growth A, Neuberger Berman, these are all mapped into the T. Rowe Price Growth Stock Fund. Page 17, the T. Rowe Price Growth Stock R was moved into the lower share class of the T. Rowe Price Growth Stock Advantage share class. MFS Midcap Value doing fine. Nationwide Midcap Index, slightly better than mediocre. JP Morgan Midcap doing well. American Beacon Small Value doing well. Oppenheimer doesn't come up on the rankings because the inception date of that was in May of 2013. So we kind of inherited that fund. UBS Small Growth doing well. In the foreign equity, American Fund Zero Pacific had a monitor tag from Q4 on the 5-year ranking 2 quarters ago was in the 46th. It dropped to the 63rd and has now improved to the 57th. And the 3-year number was 2 quarters ago 38, then 41, and it's improved to 34. But by that 57th ranking, I would say continue to monitor. Under World Stock, American Fund's growth and income on watch, and I do have a fund search, which I will show you, and it's in your black folder. You may ask the question, why a world stock fund? You have a foreign, and if I'm a participant and looking at how am I going to construct a reasonable portfolio, there's a few different ways you can skin the cat. You can use a retirement date fund. You can use, domestic equities of large, mid, and small, and you can have a international fund and a bond fund by some ratio. That would be a perfectly fine asset allocation. And if you want to really simplify it, you could have theoretically 2 funds in your investment lineup. You could have a world fund and let the manager of this fund allocate the investments to get broad global exposure, and then have a bond fund side by side, beside it to help manage the volatility. I usually like to show 3 funds in a competitive in a comparison. This is a situation where I'm dealing with Marshall Goff, and he's been very accommodating to work with. I screened 5 or 6 funds on the Morgan Stanley side because I have a process that I go through. Screen them, rankings, but then also make sure that they're approved on our Morgan Stanley's list, where we can be a co-fiduciary on that fund, and I can stand up behind a recommendation. And then I'll reach out to the record keeper and say, of these, list of funds, show me the least expensive share class you can offer the city, and still make your required revenue based on the revenue sharing. Okay, and he came back and said only 2 of those 5 or 6 are currently on our platform. So the good news is they're 2 very compelling funds, and you can see the FS Global Equity ranked 14 and 10, very good. Thornburg Global Opportunities Fund ranked 1 and 4, exceptional. MFS's approach, they look for companies with sustainable above average growth whose prospects are not reflected in the current valuation. They screen up to 2,000 stocks and ultimately have a 80 to 100 stock portfolio. They assess the business risk, evaluate growth and returns, potential, determine an appropriate valuation, and that's how they identify stocks. Thornburg takes a little bit of a different approach, and if you look at the returns, I mean, they've significantly outperformed the benchmark in short and long term, but they take a more agnostic benchmark approach, and I talked about the R-square indication of, the higher the R-square, the more index-like it is, and they have a lower R-squared of 86.54, so they're, not as constrained, and they have what's called a common term as a high active share, because in their portfolios, in this fund, they're going to have only 30 to 40 stocks. So it's a very high conviction process of ideas, and these 30 to 40 stocks, and they go through a process and hopefully comply with 3 traits that they look for in selecting a company: quality of the business, the competitive position that they have in their industry, the balance sheet strength of the company, quality management, and returns of invested capital. And the second one is the valuation of the company, and the third is what they call path to success, meaning the operations, the progress, the management leadership, shareholder interest, and fixable problems. And whatever they've done in this regard, when you look on page 6 and look at the returns, they're astonishing. And then when you look at the risk measures of that alpha of 432, a little higher beta, a high Sharpe ratio, and then that low R squared. 30 to 40 stocks, not going to be as constrained to a benchmark or an index. And I'll point out on page 8, when you look at the calendar years, and I always like to look at 08 because we know what a polarizing year in the equity markets it was, when the world stock category was down, almost 42%, and the benchmark, the Morgan Stanley Credit Index, All Country World Index, was down 42%. Thornburg was down 48, which doesn't sound very good. However, when they have, the higher alpha and the higher Sharpe ratio, so in spite of maybe the more volatility they've taken on, they have been rewarded for it.
Well, look at 07. That may be the bigger reason why it was such a good drop. Wow.
Yeah. Well, that's exactly right. So good volatility and bad volatility, but there's 2 defenses of volatility when you're an investor. There's time, so the younger you are, the more advantageous. And there's also dry powder, money to deploy. So if you're deferring every month, every 2 weeks, I should say, your dollar cost averaging, not avoiding but mitigating that volatility. And if you have the time and discipline to do that, when you look at the annualized returns, in spite of the additional beta and standard deviation, the annualized return shows that you can mitigate that and still have a good outcome over the long run in the annualized returns. So, you know, I mean, to me, I think Thornburg is, they're both good funds, but Thornburg is probably the most compelling. And you know, we need to consider expense ratio, and it is high. It's at 140. You may have noticed a trend that when you're looking at expense ratios, the fact of the matter is the spectrum of cost, it's always going to be least expensive in money market, corporate bond funds, high yield, balanced, you know, large value, large growth. And when we start getting into international, it's going to be more expensive, and then emerging markets even more expensive. And when you're looking at global, obviously you're encompassing emerging markets because, you know, if you're running the fund, you can imagine the added expense of deploying analysts, you know, in every region of the world, and, you know, trading costs are sometimes higher. So that's going to be standard across the board. Yeah, I mean, you know, I think that the best way to, the thought process to rationalize the 140, you're really looking at a 17 basis point cost premium MFS, and over 1 year period, you know, you're far surpassing that extra cost in terms of the incremental return.
It's interesting that Thornburg's only been around since the crash.
Well, it has performance going back to 07. Okay, so 07, yeah.
I don't know why I always get my hands clammy when I think about a fund that only has a few stocks. Just don't know why.
Yeah.
I mean, obviously, as you say, they have a method, and they're committed to it.
Mm-hmm.
And they stick to it.
Yeah.
And they're highly successful.
Yeah. It's concentrated for sure. You know, if you consider, take the S&P 500 for example. You know, it's cap weighted. So, you know, when the price of oil was sky high, you know, 10 years ago, ExxonMobil or Texaco, one of those large oil companies,
Right.
was the biggest, you know, weighted company in the S&P 500. But when you get down to the, you know, 499th and 500th stock by market cap, it's such a little weighting. Yet, if you're going to actually include that into an index fund, you know, you're taking on expense to buy those stocks when it has very little weighting on the actual outcome of the portfolio. You know, you could kind of say the same thing about any fund.
Well, those are the ones that probably come and go out of the index too.
Yeah, and so you have to turn them over,
Right.
and there's cost in that. So, you know, you got 30 or 40 of their high conviction ideas.
Yep. The two extremes. There you go.
Yeah.
What do you guys think?
Can't beat those rankings.
Yeah.
The rankings are
So,
Yeah.
really,
Yeah.
How much assets do we have in,
Yeah, you're looking at,
yeah, it shows it up here. 700. 700.
yeah, you look on page 13, you're looking at $1,633,592. There was another fund that was recommended and passed with a Nationwide. I remember specifically pointing out and talking to Rusty on the phone, because I think he had to vote by proxy in absentee, and he acknowledged that the fund that he voted for was a concentrated position fund as well.
well, maybe, maybe what we do for this one, Ron, is, since I give such deference to Rusty Dusty, that maybe we just make a note that we reviewed the fund search, that unless you guys have any strong feelings, that both the MFS and Thornburg look good. Thornburg's obviously a little bit better, and we'll maybe tee it up for a vote when he comes back to us.
So maybe table that for next
Yeah,
meeting.
maybe.
Yeah. And by the way, you
The
know,
last thing I want to
Yes,
do
we
is
feel
have him do.
strongly about.
The last thing I'd like to want to do is have Ron do a phone vote and have Rusty lose, 7-1. That I don't need that grief.
Yeah, he needs to weigh in.
yeah. And you know,
Him to either argue his case.
yeah, and you know, you could certainly rationalize tabling it, because on the 5-year number, the last 3 rankings are 71, 67, 58, so it's trending positive. So on that, you could certainly keep it in the lineup another quarter.
Yeah, I won't hurt anything.
Well, if he doesn't respond, it doesn't vote, then we wouldn't have a quorum. So that's cool.
Well, he'll make the next quarter session with you. I'll share a joke with you. So, for the record, Chris Collins, the I suppose soon to be president of the PPA, and Rusty McAllister have they're renting a house up in Carson City during the session, so that's why. And he happens to be right next door to one of the ladies that's the operations manager for PERS. And so she sees them a lot. And both Chris and Rusty are on PERS. They're on the PERS board too. And so she coined a name for them. They're a unit. She calls them Crusty.
Crusty, nice.
Just for the record.
Like a blend of crusty.
Crusty.
Nice. Do they know she referred?
Oh, you bet. they know.
Okay.
Oh, you bet.
I'm sure they'll get a
Every
kick
point.
out of that.
Yeah.
A little
I
levity
think I
is
put
good.
that on the record on the PERS board too.
So back to page 17. American Century Real Estate, that was a fund we added, doing fine. Page 18, IB Energy, we added that, ranking nice. And there's our new T. Rowe Price retirement date funds, ranking great.
Looking good.
And then, so for the investments, for the most part, we're in very good shape within Nationwide. And the last item on this agenda references a benchmark report for Nationwide. Remember, going back last quarter, I presented 2. Nationwide was very, very slow in cooperating, getting the data required. has since come through with that, and the report looked extremely, extremely high in terms of their costs. And so, at the recommendation of Chairman Vincent, and in fairness to Rusty, give him a chance to be presented it and look at it, and then decide, how we would like to act on it.
Yeah, I just think we're waiting for the session to be over for you to have a little meeting with him. And I think we can tee it up for our discussion at the next investment committee meeting. Let me see if we prepared.
It'll be interesting to see because the understanding is that the firefighters have a national deal with Nationwide, and something I wouldn't even begin to know how to try to quantify what the value of that arrangement is. But for Rusty to have this report, what does he do? Does he go back to his national, brethren and say, hey, here's what we turned up in Vegas. If you guys, benchmark yours nationwide, and maybe he can do some good for his own people. Or even if it's nothing at the national level, if he never has an appetite to consolidate away from Nationwide, at least maybe he can have this to now go leverage to Nationwide, say, lower our fees. So,
Or he can, he does have, the firefighters, as most of us recognize, unlike the police, they seem to have a very strong national union, and Rusty is pretty involved with them, certainly on a regional level, but I think also on a national level. So he has a shot of raising the awareness there and seeing if the group as a whole can put some pressure. But even if not, we, at least here, we still have an investment committee. We still have some authority
yeah.
to give some direction. But again, I think Rusty will. I think Rusty will respond appropriately.
Yeah.
You're going to show him, so we just got to give him a chance to do that.
Well, here it is. It's 3:45, and we've scheduled these meetings for 4 hours. But isn't it interesting
We
how
didn't start at 1:45.
we started late, and we had less committee members, contributing discussion. So maybe that minimizes the time. But isn't it interesting now to look back to say we started with 3 plans of this weight. We got it down to something we can kind of control now, and there's less to talk about and trending positive. So
It's a good thing.
yeah. One idea I have for next meeting, and by the way, I collaborate with Ron and Bob on the agenda items to come in here and hopefully have some meaningful content. But you've expressed an interest in committee education, and the extent of it today was kind of that debriefing of the Mass Mutual general account. But one thing I did for Station Casinos that they seem to appreciate is an asset classification, meaning an asset class analysis. So, I came in here a couple of years ago, and you guys are investing. But, what discussions, if any, happened way back at the inception of these plans to say, what asset, before you even pick funds, what asset classes would we like to expose our participants to and give them a chance to build a fundamentally sound, diversified investment portfolio? Then if it was starting from the ground up, then you pick, the best-in-class funds and start with high-ranking funds and make changes as you go. Here, we inherited a lot of funds, poorly ranked, and had to adjust as we go. But to show you asset allocation models of the Morgan Stanley's Global Investment Committee, to show you what, what the opinions that they have of what a diversified portfolio should look like across 8 risk profiles. And see the different asset classes that are exposed in those models, and then compare them to the asset classes available in your plan, which is extensive. And then I would probably show you, maybe even write up that whiteboard in a live demonstration of the Morningstar style boxes of large, growth, mid and small, blend, mid and large, mid and small, and small cap. The 9 style boxes, and show you, within the funds, how many different ways you could build a diversified portfolio. Would that be of value?
Yeah,
Yeah, I think so.
yeah.
Okay.
It's one of the benefits of being on the committee.
Can learn stuff, yeah.
Okay.
You're laughing, but it's the truth.
And yeah.
I'm also thinking,
Yeah, it's good.
we implemented, I think we implemented the ability to create a brokerage account, right? Did we do that? Didn't we implement that?
I'm sorry.
A brokerage account?
Self-directed brokerage
Yeah,
account.
didn't we do that?
What do you mean? Did we do it?
Dan's not here. If we did, I thought we gave him direction that we were okay with that. If we did open that up, I'd like to know what the participation is. Just out of curiosity. I thought we gave him direction to do that.
You
The other
mean-
thing, Ron, we may want to talk about or not, I'll give it some more thought. Maybe I should talk to Bob about it, but, potential plan changes for elective deferrals into the 401. Elective deferrals into the 401. Bob will know. I'm just thinking. Bob will know. I'm just, if we're going to talk about making plan changes that would allow for that, then we probably ought to talk about it here in the committee at some point.
You mean elective deferrals as opposed to just getting the match in there?
Yes. Yes. Yeah, I'm being told that we could modify the plan that would allow you to make an election in the following year, how much you would defer, or I'm not exactly sure how it would work, but it could be just a flat deferral percentage. You would elect for the upcoming year for any separation or severance type payments. So if on the course of the next few months we're moving in that direction, and our tax counsel tells us, yeah, you can do this and such, and we're thinking about it, then I'm thinking that should be presented and I don't think the committee's going to have an issue with it at all. I think it's informative, if that makes sense.
Do some appointers who get that match get the match
In the 401A.
but don't they?
So our match goes into the 401A, and it's based upon basically it's based upon years of service and by position, so to speak.
Does somebody have to make a deferral in the 457 to get the match?
Yes, you have. Yeah, it's a
Okay.
match. It is a match.
Okay.
If it's zero, you get zero.
Yeah.
It's a dollar for dollar match. The maximum amount of match is $8,000.
Let me ask you, just to,
But now we're talking about making an elective deferral
yeah,
based upon based on severance.
Not
and
earned income.
separation. Well, it's not based on time worked.
yeah.
types.
But is separation and what you're saying, is that considered W-2 income?
Yes, it would be W-2 income.
Okay,
So we have a severance package based
Yeah.
on user service and whether you're retiring into PERS or not. We also, at the city manager's discretion, and usually comes about through separation agreements, specific separation agreements. But we have the ability, the city manager has the ability to provide additional separation pay, if you will.
and I'm curious,
And the question is, can you electively, person by person, defer part of that into the 401A?
and why the 401A instead of just the 457, when all the other
Because the
deferrals?
401A's got $53,000 cap, whereas the 457's got a max of, what is it, 36, if you're within.
When you retire.
Yeah. within-
Oh,
So it's, you can put more money into it, that's the issue.
I see.
So if we were deferring, if we're putting the match in the 457 and then we're putting deferral of separation pay into the 457, you'd never be able to max out your regular contributions.
I see.
So it's just, it's a sheltering scheme.
I see. Yeah. Interesting.
Yeah. So anyway, that all makes sense. But so if Bob gets to the point where he gets a good report from the tax lawyer and we decide we want to move forward with the plan change, and we probably ought to just present it here. We can do that. Could make Bob do it. Yeah. Make Bob. All right, so that's it for our regular business.
That is it.
All right. Thank you, Edward, for joining me.